Are you ready to make the most of your oil and gas mineral rights? Welcome to the Mineral Rights Podcast. Get the knowledge and resources you need to manage your minerals and royalties. Here is your host, Matt Sands.
Hello and welcome to the Mineral Rights Podcast. I'm your host, Matt Sands, and I'm joined by my co-host, Justin Williams, and we're here to help you make the most of your minerals and royalties. In this episode, we're going to talk about Economics 101 for mineral rights owners, and this is something I think that's important, as we were talking before we hit record, Justin, to think about and understand the factors that can influence what you get paid in royalties, as well as the overall value of your property. And there's a lot of things that influence that, some of which we have control over and a lot of which we don't. And what we wanted to do today was to really talk about like the economic literacy side of things from a mineral owner perspective, and the thing that everybody needs to know, because I think it helps inform the decisions that we make in managing these types of interests.
It puts some reason to why things happen when they happen, and you can kind of see the levers and why the prices went up and went down. Though, like you said, Matt, we may not necessarily have control over, especially the macroeconomics that set the price of oil and gas.
Yeah, that's a great point, and we'll talk a little bit more about that here in a second, but just want to give a shout out to David, who's a listener who wrote in, and this ties into the listener question episode that is going to drop right around the time of this episode. And in that episode, we talked about a couple of suggestions he had for future podcast topics. And one of those was to talk about the actual macro and microeconomic perspective, really economics as a whole, and how it affects mineral rights. And one of the things that we have done in the past is talked about global commodity prices. In fact, most of the monthly news episodes anymore, there's some geopolitical event that's happening that's influencing oil prices. And so we, touch on that certainly, and have touched on that several times, over several episodes. And we've also talked about sort of the micro side of things as it relates to individual areas within the United States, basins where oil and gas is produced, and talked about different constraints that are in place and how that affects prices there locally. But what we wanted to do today is really pull that all together in a comprehensive overview of how economics affects the decisions that are made as it relates to owning minerals and royalties. And so you can be more informed and understand when you read a news article and it's talking about oil prices, or it's talking about some event that's occurred in your area as it relates to oil and gas production or takeaway capacity or pipelines or something. And you can then infer from that and say, oh, well, that's interesting. I understand that because of that event happening, this is how it's going to impact my royalties next month, based on the prices that I'm getting paid or things like that. So ultimately, minerals are an economic asset, and the value is shaped by forces that are both outside of our control. Again, like Justin, like you mentioned, I think is a really good point. We talk about global commodity markets. We can't, the things we do in our day-to-day life aren't going to have any impact on the benchmark crude oil price. West Texas Intermediate is what we're most interested in here in the United States. And ultimately, it's more supply and demand that influence that. And we'll talk about why that is the case. I think, Justin, it helps maybe if we start with a big picture view and, the macroeconomic perspective, and then we'll zoom into, our individual minerals and, what do we need to be thinking about. So do you want to talk about the big picture side of things and the forces that impact oil and gas prices?
Sure. So if we're looking at it on, we talk so much about oil and gas prices and how much that impacts, and it all trickles down. But on a high level in a global world, it's the basic supply and demand framework. And we talk about that often. Oil gas is priced in a global marketplace, like you mentioned, Matt. Just like stocks or real estate, supply and demand is what determine that. When more buyers want oil than sellers have available, prices go up. When the supply floods the market, prices fall. Economic growth is one of the biggest factors affecting petroleum product demand. Growing economies mean a higher demand for energy, especially for transporting goods from producers to consumers, petrochemicals, industrial industries. When the global economy is humming, then factories are producing, they're using the industrial chemicals, goods are being shipped, and there's growth overall, Matt. And that is, we hear a lot about that in the news, different geopolitical events causing supply and demand constraints, and it can really move the needle a lot, like we're seeing right now. Also, Matt, there's OPEC and a role of organized production control. I think that's something that we hear about less than we used to, right? So OPEC can significantly influence oil prices by setting production targets for members. Saudi Arabia historically has had the largest share of the world's spare oil production capacity. And when it decides to open or close the spigot, global prices respond. And oil prices are not driven not only by the current supply and demand, but also by expectations of future supply and demand, Matt, which I think is something that is easy for us to forget. The futures market is a very important component when it comes to oil and gas pricing. OPEC tries to adjust its production targets based on those expectations, which makes estimating future prices particularly challenging when market conditions are uncertain and evolving rapidly. And then geopolitics, like we're seeing currently, weather and the risk premium all kind of play into the pricing, along with sanctions and other political things going on in the world. When you have major producers who are exporting, even 10 million barrels a day to 50 million barrels a day, that can have an impact long term when you remove that from a supply chain. It's going to move that supply and demand needle. In history, OPEC played such a large part in some of the pain that we felt in the oil and gas market. Because of that, in the past, OPEC was really that external driver that set the oil prices. And we've moved the needle a bit over the past 10 years or so. And the U.S. has become the number one global crude oil producer. So that's helped to really kind of dampen some of the effects of OPEC's decisions on oil prices. And we see that in the news map. We're not talking about OPEC decisions near as much in the past few years as we were even 4 years ago.
Yeah, that's a great point. I think that is the big takeaway there is that the U.S. is very much, in control over the price of West Texas Intermediate crude. And there's been a little bit of a disconnect we've seen between the price of crude oil, and certainly it's gone up here in the U.S., but, with this whole Iran conflict and how the price of Brent crude, which is sort of the global benchmark price, that's gone up quite a bit. Whereas, West Texas Intermediate's gone up just because the overall demand for crude oil has gone up, and oil is generally fungible to a certain extent. In other words, a barrel of crude oil that is of a certain grade, light sweet crude oil that's produced in the United States is roughly the same value or same product as light sweet crude oil that's produced anywhere else in the world. The issue is just trying to get it to where it needs to go to the market, where they're going to actually convert that to gasoline and diesel and other products. But the ultimate takeaway there is that U.S. has more of an influence. And so, whereas in the past, we were very much at the mercy of OPEC and whatever they decided. And there's been a bit of a battle, as we saw with the post-COVID crash in crude oil. It was the first time that the price of oil went negative. In other words, they were paying to people to take it away just because the demand had cratered. And the Saudis and other OPEC members decided to turn the screws on U.S. producers. They didn't like it that we were actually getting more of that market share that they traditionally had. And so they flooded the market with supply that caused prices to crash in the midst of, everybody staying at home, not driving. The demand had cratered because of COVID. And so that caused a lot of those U.S. producers to go bankrupt just because they weren't managing their books efficiently. They were focusing too much on growth rather than being profitable. And so that really changed the way that these U.S. oil and gas companies are run. So that is less of a risk, I think, in the future, because companies aren't spending more than they're earning. And so they're not getting over their skis like we did during COVID. So all that to say that, now that we are in a very good position, I think globally from a oil perspective, we have a lot of control over, our own destiny, because if OPEC decides to, they want to drive up prices or do something that's going to maybe impact our ability, as far as using it and for transportation and things like that. Obviously, there's other effects of increasing energy prices on other products, not just oil and gas derived products like gasoline and diesel and natural gas and things like that we use to heat or for transportation. So yeah, ultimately, I think the big picture here, geopolitics still affects prices as we're seeing today in April of 2026, obviously with Iran and the increase in oil prices. The question is that, should oil actually be trading at like $150 a barrel? So while we think it's gone up quite a bit, and it has, I think if the U.S. wasn't in the position we're in now, the price of oil would have gone up way, way higher than it is. So I think that is something to think about as well.
And Matt, with natural gas, we often talk about different positionings in the United States and how natural gas pricing can really affect a royalty owner's check heavily. And part of that is because it's really a bit of a different animal in and of itself. It's not the same market as oil. You've got different transportation. There's a lot of regional things that impact it, and the price is driven by different factors. We talk about cold winters impacting oil and gas, how much they can store, and then exporting as well. We've talked about the exporting hubs coming online in the United States. And so I think that's another factor that really is a macroeconomic. We don't have a lot of control in natural gas pricing, but it can be a factor that can make a huge difference depending on some microeconomic factors, like where your well is located, what is the actual production of that well, and what the market might be doing regionally in that area.
Yeah, that's a great point. That's a good segue to the sort of the microeconomic side of things. But before we make that transition, one thing I wanted to mention as it relates to uncertainty and all these events that can affect global prices, there's this thing called a risk premium you'll hear in the news. And I wanted to mention that because what that's referring to is where traders and the market, the people that are setting the price, basically those that are buying and selling oil or natural gas, the market will build in what's called a risk premium. In other words, the potential for something happening around the supply disruption, even if those disruptions haven't happened yet. So that's often why you'll see prices will tick up, leading up to an event, whether it's a geopolitical event like this Iran thing, or if it's a weather event like a hurricane, for example. Next time during hurricane season later this year, next time there's a named storm coming through the Gulf of Mexico, watch what the price of crude oil does leading up to when that storm even enters the Gulf. It'll tick up because of the expectation that it's going to cause supply disruption. And, once things happen, often if the disruption wasn't as bad as we expected, then prices will crash, so to speak. They'll drop further down below where it was before the event. So really interesting dynamics that happen. And I think when you have human intervention or involvement with these markets, it's chaotic and unpredictable. If somebody were able to predict the price of crude oil or natural gas perfectly, they'd be trillionaires. And I think that's part of the challenge and why companies are looking for all kinds of proprietary information they can glean to understand what the impact on prices is going to be to give them an advantage so they can take advantage of that price going up or price going down and make money on that. And that's what hedge funds do and others that are playing in the global commodities trade. But, I think that when you're thinking about these global prices, that's at a benchmark location. So I think it's important, like Justin mentioned, Henry Hub is a physical pipeline interconnection in Louisiana that serves as the reference point for pricing domestic natural gas. Things that go into the pricing is storage levels. So with both natural gas and oil, they look at what the market is doing in terms of adding to that storage or drawing down. And if there's a surprise draw from storage, that can cause a price to tick up. As natural gas, I think, seems to be a little bit more sensitive to these types of events, and it goes up and down more erratically. I feel like based on past experience, it's maybe becoming more interconnected now that we have a lot of LNG export capacity. So that's one thing that you'll hear about with natural gas that's driving a lot of demand is our ability to liquefy it and put it on these big tankers to send it to Asia or to Europe. And so that is adding some additional demand, and that helps balance prices at a certain floor, a certain low, minimum price that's higher than maybe it would be otherwise, because we have the ability to send natural gas to other countries now that we didn't have the ability 10 years ago. So if there was a warmer winter than expected, prices would really tank. Now they go down for sure, but then maybe they're not going as low as they would otherwise. So when we think about natural gas prices or oil is the West Texas Intermediate is traded in Cushing, Oklahoma. That's where the benchmark price is set. So when we talk about a basis differential or the price that's actually paid at your wellhead, wherever that is, whether it's in Oklahoma, Louisiana, Colorado, Wyoming, Utah, you're going to get paid a different actual local price than what the market price is in Cushing, Oklahoma example for crude oil. Justin, do you want to talk about that basis differential or that spread between the benchmark price and the local price and some of the things that can impact it?
I think an analogy is a good way to put this. And imagine you grow remote apples in a remote valley with only one road out of the valley. If that road gets washed out, you can't get your apples to the market. So either have to sell them cheap locally or sell them not at all. And mineral owners face that exact same dynamic with oil and gas pipelines. There was a lot of history in West Texas when the shale revolution was happening, and there was a big boom where the Permian to Cushing differential widened to $10 to $15 per barrel. And that severely impacts producer realizations and royalty owner income. When you're sending this to market and you're expecting one price, your economics are set that way. And it can happen both ways, that more is paid or less is paid. Matt, another area where we've talked about this a bit before, in Utah, some of the crude that comes out is a very heavy, waxy crude. And to transport that requires heating that to keep it in liquid form so that you can transport it from one place to another. Energy equals money, and so it costs to provide that heating, which could cause a huge differential in the transportation cost or the infrastructure cost from getting oil or gas from a remote production area to a buyer. And that gets factored into the price that's actually paid in a local area. Like we've talked about a lot, Matt, there's also quality differences in oil and gas. So the price that's paid can depend on what exactly that product is that's being paid and how much that product's worth. For example, if it's for primarily industrial chemicals, maybe there's a market in and of itself, like marine lubricants, that actually controls that price. And there's a supply and demand aspect to that in and of itself.
Yeah, that's a really good point. I think that when you think about the bigger picture, you could ask the question, what is the quality of the product that's being produced by my well? In other words, is it light sweet crude that has low sulfur content and is easy to transport? Well, maybe there's less of a difference between West Texas Intermediate and your particular price that you're getting paid versus is it heavy sour crude? So in other words, the sour, it's got high sulfur content, hydrogen sulfide. It's more costly to produce and manage. And they have those impurities that they have to be taken out in order to use it and to refine it. And so those are the things that can impact from a quality difference. And then, like you mentioned, Justin, I think Utah is a great example where the difference that's paid there in the Uinta Basin is much lower, like $10 per barrel lower often than West Texas Intermediate because of the transportation and infrastructure costs. It has to be put into rail cars and sent by train because there's not the pipeline infrastructure, and the characteristics of that oil make it difficult, if not impossible, to pump through a pipeline in an economic manner just because it would plug as it cools down. That at room temperature, that oil is solid, right? It turns into a wax ball. And so the pipeline would plug and they wouldn't be able to pump it. So they have to send it by train, which is more expensive. There's those types of factors that play into in that basin what you're getting paid. Then from well to well or lease to lease, it can vary even further. So you might have one operator that has a contract to sell oil at a certain price, and then operator B next door, the same infrastructure, the same location, quality, everything else, all things being equal, they get paid a different price just because of the contractual obligations that operator A may have versus operator B. And that can influence what you actually get paid. And when you look at your royalty check, that price that shows up there, how much have they hedged and what types of purchase agreements do they have in place and what kind of cost go with that, right? And that gets oftentimes passed on to us, whether that's in the price that they're paid for that product or actually in post-production deductions that we get charged.
And again, man, many of these macroeconomics we really don't have a lot of control over. It's, a lot of times we're impacted by this. Maybe we're impacted by it on a local level. Maybe we're impacted by it on a global or a national level. But there are some other aspects, if you kind of zoom into the property, that play into this. Some of those we have control over there. Some of those we don't. And sometimes a situation of what kind of owner you are, if you're looking to invest in minerals, did you inherit these? All these little tiny factors play into this. But what we've talked about so far has really been on, taking a step back, looking at it on a global level. Much of it we don't have impact over, but it does make a difference in pricing for very logical, rational reasons once you get into it.
Yeah, and I think when you look at the pricing and you think about those types of things, I think one thing I want to mention, I think another great example is natural gas in West Texas is a great illustration of that local level influence on prices, where you have an excess amount of natural gas that's produced as a byproduct of oil production in the Permian Basin. And natural gas production in the Permian has more than doubled over a 5-year period. And so now we're at the point where the Waha hub, that's where the natural gas trading occurs in West Texas, those prices have gone negative just because of the boom in crude oil production. And they're producing all this oil and they have pipeline capacity to take that oil to market. Well, they're also producing a lot of natural gas as a result of that, and they have to do something with it. Well, in the case of the pipeline takeaway capacity, the production is more than what they can actually send to the market, and so prices have gone negative. In other words, operators are paying companies to take away the gas, and as a royalty owner, we feel that in terms of also not getting paid, for the gas that's produced. We actually oftentimes will get a negative royalty, whether that's due to actual prices that are paid, or it could be because of post-production deductions. When you subtract those from the price that is paid, that's a very low price, you actually have a negative number on your royalty check, which doesn't make sense when you think about royalties. We should be getting paid positive numbers, but obviously that's offset by the LNG and the crude oil that's sold, and so we get a positive royalty check and not a bill. But that negative price basically means that more gas is being produced in West Texas than there are pipelines to carry it away. And while there's the benchmark Henry Hub price of $3 per 1,000 cubic feet, Waha Hub may be negative $5, which means that they're actually looking at alternative ways to deal with that gas. And that's why you hear about these big data center projects going in, and Bitcoin mining and other things that they can actually put in West Texas that are at the source of that low-cost energy, that operators are going to get some positive number for the gas. And then companies can take advantage of that low cost of electricity for, again, those other uses where they can be off-grid, Bitcoin mining or AI data centers or whatever it is. So, that could be an alternative way to deal with that, is to bring the market to the source versus putting the infrastructure in to take that gas to market, in Louisiana or wherever it is. So the practical takeaway there, I think, is to look at your royalty check and to understand these things that are influencing it. And if you see a negative number, or if you see a very low number, whereas if you read an article that says, well, Henry Hub is $3, why did I get only 75 cents per MCF? This oil company's ripping me off. Well, maybe not. There are other factors that are influencing what you actually are getting paid on your royalty check that are based on the location. And tying that back to what Justin said, we don't have an influence over where our property is located when it comes to the location if we inherit them, right? Obviously, we're given that property, and it is where it is. If you're investing, you can have an influence over maybe where you want to invest your dollars to maximize the value when it comes to these microeconomic trends. And you can go to areas that there's a lower price differential between those two. Or if you're buying a property, to understand that I'm only going to get paid, I'm only going to put value on the natural gas at 50 cents per MCF, or maybe I'm not going to put any value on the gas because I think there's going to be issues with takeaway capacity for the foreseeable future, and I'm just really going to pay for the oil. Or you can do things to hedge your bets in terms of from that side of things. But I think that's important to think about when we look at the value of our specific properties, which, you obviously have to understand the global pricing and what the impact is there, but then you also have to understand a little bit about the local market too.
I think that's a good way to sum it up, Matt. And when it comes to your property, right, we talk a lot about evaluating your minerals, and we talk a lot about the evaluation process and how we're looking at the actual formations of the well. We're looking at the production history. We're looking at what you can sell the produced goods for. I think that kind of all can fall into what is it that's actually under the ground. Where is this property located? What is the realistic production potential of that property, both now and in the foreseeable future? Which, is a huge lever and can make a lot of difference even for people in a small area.
Yeah, that's a good point. And I think, when you think about your particular area, it's important to understand how those wells are going to behave. So when we talk about like honing in even further on like a micro level at the geology of your specific area within the basin, you can use the State Oil and Gas Commission website to look at well production of wells that are near your minerals. And so maybe if you don't have any wells that have been drilled yet, but you want to understand, you just recently leased and the operator said they're going to drill 5 wells next year or whatever. You want to understand, well, how much are they going to be producing and how much is that going to mean in terms of royalties? You can start to get an idea by looking at nearby wells. And it's important to understand that as you get those first royalty checks, they're going to be very large. And that is because these shale wells, these horizontal wells that are drilled, it's not uncommon to see production fall 50 to 70% within the first 12 to 18 months. And what that means is that at the very beginning of the well, you're going to get high income and you're going to get really large volumes of crude oil. They're going to be making 20,000, 30,000 barrels per month per well. Well, that's not going to continue forever. And that's important to understand that so you don't go and, buy a new truck when the next month's check is all of a sudden 50% less and you're surprised and you can't make your car payment or your payment on the note for that truck, right? So it's important to understand how these things behave and understand what that's going to mean. And the long-term value also depends on that decline curve. And that is what we talk about, that production over time and how it, will be really high at the beginning and then declines very rapidly and then sort of flattens out. But understand that that's normal behavior. Don't panic when that royalty check drops, precipitously month over month, from the first couple of months to subsequent months. The things that you need to worry about or things where there's an issue is when you don't get any production, like maybe they don't send you a check or production is 0 barrels, and maybe that indicates there's an issue. At the end of the day, you should understand, have a high level picture of what that cash flow forecast is going to look like, so then you can budget accordingly. Ultimately, those are the things we don't really have control over, though. The one thing I want to maybe hone in on, Justin, and we can focus on this before we wrap things up, is what are some of the things that we actually do have control over? Again, let's just say we have property that we've inherited. We don't know. We don't have influence over the location. We don't have an influence over the geology. We don't have influence over the well production. What are the things we do have an impact on that will impact the value and impact the economics?
We harp on this constantly, Matt, the royalty rate. The royalty rate is that one lever that really has a major impact. That royalty rate is the percentage of gross production revenue you'll receive from any well drilled on your land. And that's negotiated at the time of leasing and then typically locked in for the life of the lease. Matt, it can make a huge impact. The royalty rate functions as a permanent multiplier on every barrel of oil or cubic foot of gas produced from your land. Whether that's one well on your land, whether that's 2, 4, 6, 8. It can really make a huge difference and compound over the life of multiple wells. And that difference can add up to tens or hundreds of thousands of dollars in a difference in income. We always say this, but it's the number one thing to really look at, especially if you're, looking at a lease that is likely going to go on for many, many years, even beyond your lifetime.
Yeah, that's a really good point. I think that's why we always, like Justin said, we harp on it. We can't say it enough that negotiating for as high a royalty rate as possible is the best way to preserve the value of your minerals. Just negotiating up a couple of percentage points on the royalty rate doesn't sound like it's going to be that big of a deal. But if you were to, negotiate a 1/4 royalty, or in other words, 25% royalty versus a 3/16 royalty, you've just impacted the value of your property by 33%. In other words, if you have a 1/4 royalty, somebody wants to make you an offer to purchase your minerals, they're going to offer you 33% more for that property as compared to if you had settled for a 3/16 royalty. Now, both are great royalty rates, but it's important and that's why we keep harping on it, like Justin said. And that's one thing that we do have the ability to influence. Everybody, no matter how few acres you own, you have the ability to influence the value by negotiating for the highest royalty rate possible. There's other things you can do to impact the value, such as putting in continuous drilling language and things like that. If you have a large mineral tract and you have the ability to influence the timing of when wells are drilled, by giving the operator the lease and saying, well, we'll sign this lease with you, but we're going to put in here the fact that you have to continue and, to drill a certain number of wells per year or whatever over time and that's how you can help impact the value of your property by bringing forward the timing of when those wells are drilled, because that's the next biggest lever on value is the time value of money. When you get paid matters as much, or almost as much, I should say, as how much you get paid. And the reason for that is because $1 today is worth more than the promise of $1 tomorrow, or sometime in the future. And that's because of a couple of different reasons. One is inflation. Obviously, we're feeling that in our pocketbooks now. Price of food has gone up. I've noticed month over month. I keep going to the grocery store and, that was $1 cheaper last month. What's going on? That means that as prices go up, $1 will buy you less and less as that trend continues. The other thing is the opportunity cost. If you have, let's say, $1,000 today and you want to invest that at a certain interest rate, well, you can get a return on investment, and 10 years from now, that could have doubled or tripled or quadrupled or even more, depending on what you invested in and the rate of return that you get. So the $1 today, you can actually invest it and make more and have it be worth more in the future. Another reason is because of uncertainty, right? The things can happen, right? The well can stop producing, or you can get the market to crash and they don't drill a well. And so when you talk about royalty payments, the further out that royalty payment is, the more risk there is, or more uncertainty that it's actually going to get paid to whoever owns those minerals at that point in time. And that's why when you go to sell your minerals, the company that's making the offer is going to factor those things in, that time value of money element. They're going to look at what that well is producing, how much it's going to produce in the future, and they discount it, at a certain interest rate based on what they need to make for their investors, as well as, to factor in those risks and uncertainties and inflationary elements into the offer. And so, there's a trade-off, right? You get the value today. Maybe it's $10,000 versus if you held on to that property for the life of those wells, you would get $30,000 over the next 30 years. Well, there's no guarantee that you're actually going to get $30,000 or, that those wells will continue producing. So there's that risk that you're trading off when you sell. So those are the things that I think it's helpful to think about when it comes to time value of money. And we talk about a little bit more about this, and we'll link to in the show notes some of the episodes where we talk about how minerals are valued, because we talk about that in more detail about timing of wells is really important, discount rates, discounted cash flow analysis, and how that's all done. But, Justin, I think maybe we should wrap this up and, before people's eyes glaze over any further, talking about economic terms and things like that. But, maybe let's break this down in terms of what does this mean if you own undeveloped minerals in West Texas? Let's talk about some of these terms that we've mentioned during this episode so far, and how that could impact that particular mineral owner over the life of that property.
Matt, I think it's a big picture. And like you said, it can get to be a really difficult thing to wrap your brain around in all the different ways. But macro, micro, and time really all interact. And it's why mineral rights evaluation is genuinely complex, Matt. When you're doing a evaluation, you're looking at the factors that we don't control, like current prices. You're adding in that micro element of the research of the wells, economics itself, the reservoir. What has it produced? What will it produce? What could it produce? And then time, taking that discounted cash flow, how can you get the value out of what that dollar would have been worth in 10 years today? It's a large landscape that you're looking at. And a few practical takeaways, I think, Matt, for mineral owners is don't confuse your current royalty check with permanent income. There's so many factors at play that we've talked about today, which can impact that income almost at a whim. Many of those we're not in control of. The economic value of that declining stream shrinks each passing year. And it really kind of depends on so many different factors that can sway year over year. Undeveloped minerals have speculative value tied to timing. So an acquisition or a lease offer reflects what a buyer thinks the discounted value of future wells is worth. And this is really heavily dependent on when drilling is expected. So Matt, if we talk about the early 2000s and a time period where production was just so slow, the value of those undeveloped minerals was very low because there really wasn't a whole lot of expectation on the horizon of when we might start drilling again or developing those undeveloped assets. commodity prices interact with timing. So when oil prices are high and your property is undrilled, now it may be an excellent time to lease because operators are motivated to drill quickly, supporting better lease terms that you can negotiate with them. When prices are low, operators may not be in a hurry, and it could extend your wait and reduce the value of those future royalties. And then again, last but not least, the local can really make a huge difference, Matt. And I'm sure in your evaluations, you see that take effect very often in that, if you're looking at a property in this area versus West Texas, I'm sure there's huge difference in prices, and you can see why from the supply constraints and the development, the infrastructure, how risk tolerant operators are, and how they feel about the sentiment of transporting and what they can make from it.
Yeah, we look at all of that, and we look at the actual prices that are paid, over the past 6 months or so, at the wellhead, and we looked at in the future is if that trend continues in terms of the discount to West Texas Intermediate or to Henry Hub, we have to factor that in determining the value, because ultimately that'll impact how much royalties are actually paid for that well. And that, obviously has a direct impact on the value. But yeah, I think that's a great way to sum it up, that when you have to think about all these things together, the macroeconomic perspective, in other words, the global oil and gas prices, the micro in terms of your local geology, your local pricing, as well as time. Time is such a huge factor on value when it comes to when wells are drilled, or when that production occurs over the life of the well, and how much is produced month over month. That all factors in directly into the value of that property. So all of those things together, I think it's important to understand at a high level economics as it relates to minerals and royalties, so that when you hear those news articles or you read a story about a local pipeline compressor station being down and for maintenance or something, and you can realize, oh wait, that's going to impact my gas prices over the next month probably. And then things like hurricanes and major events, weather events that can cause prices to spike for the short term before the macroeconomic side of things takes over again, and things balance out from a supply and demand. Now, one thing I want to mention before we wrap up, just to throw another term out there that you may hear when it comes to oil and gas, and that is price elasticity. That's a term that's used in economics. And what that refers to is how sensitive the demand for a product is based on the price. So, for example, if we wanted to buy a new computer and the price has just doubled, well, we may find that, that's a discretionary item. We don't need it for work. We just want to use it for sending emails or watching Netflix or whatever. Those types of purchases are maybe more price sensitive. So we have a certain budget, the discretionary money we want to spend on that new thing, whatever it is, computer, toy, whatever. We're not going to buy that if the price doubled overnight, right? We're going to say, well, I'm going to wait until maybe prices come back down, or, I don't really need it that bad. I'll just wait and, get something else. Whereas oil and gas are so instrumental to our current quality of life and the mechanics of everything in the global economy, that if the price doubles doesn't mean the demand cuts in half. The demand is inelastic when it comes to being impacted by the price. So that's one thing to keep in mind with oil and gas, is that the demand is there no matter what. The price is $60 a barrel or $120 a barrel. There's still that demand for, gasoline, for diesel, for transportation, jet fuel, for the basic products, for energy, for heating our homes, things like that are going to happen no matter what. So that's an important thing to think about when it comes to oil and gas and how it impacts our day-to-day. To really talk about economics, and there's more stuff you can read about, and we'll link to all these resources that we used in preparing this episode in the show notes, and I encourage you to go and listen to a couple other episodes specifically that talk about the methodology and the impacts on mineral rights value. So episode 4, we talk about how mineral rights are valued, kind of the high level methodologies that are used. Episode 194 is also a little bit of a deeper dive on calculating mineral rights value. There's a couple of other episodes we'll link to in the show notes that you can go a little bit deeper if you want to learn more about that. Justin, anything else to mention before we wrap up?
I think it's worth mentioning that if you're early in your mineral rights journey and the micro side, you don't really know much about your property or your information, a great place to start is that Mineral Managers Basics course. Really understanding how to find the documents, do the research, understand what you own is step one.
Yeah, absolutely. And that is where you can learn about how to find out what the other wells near your property are producing, and then use that again, like we talked about, to see what the decline might be in those new wells that are going to get drilled on your property. With that, we'll wrap up and say thanks again for listening, and we'll see you in the next episode. Thanks, Justin.
Thanks, Matt.
Thanks so much for listening to the Mineral Rights Podcast with your host, Matt Sands. Don't forget to subscribe and share at mineralrightspodcast.com. The Mineral Rights Podcast should not be construed as investment, legal, or tax advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy.